First of all, thank you very much for attending our webinar that's jointly given by Guidehouse and by Pillsbury on the Community Reinvestment Act, the proposed overhaul, and some other key fair lending issues. Just in terms of just some background, we are recording and the session will be available for others to listen to if they wish, and certainly we are happy to share the slides as well. Also, for those of you who want CLE credit, we've arranged for credit in New York, California, and Texas since submitting in Virginia. Towards the end of the presentation, we will also have the number that you will need for CLE purposes. And I guess with that, I'm Deb Thoren-Peden. I'm a partner at Pillsbury Winthrop. By way of background, I spent 10 years in-house at a bank. And while I was at the bank, CRA was one of the things that I got to work on. And I always thought it was fascinating, especially in the context of getting to meet with some of the community groups to figure out, what could be done to better their circumstances under some situations. And with that, I'm going to let our other four speakers, who actually I think have incredible backgrounds, introduce themselves. So with that, Congressman Clay, do you want to start with your background a bit, and then we can go on to the other panelists?
Thank you, Deb, for the handoff, and welcome to the viewers, and thank you for all of the participants here. I come off of a 20-year stint in the U.S. House of Representatives. I'm just finishing up 1 year here at the Pillsbury Law Firm as a senior policy advisor in the public policy section. While serving in Congress for 20 years, I served on the House Financial Services Committee. During those 20 years, I made it intentional to serve on each of the subcommittees to get a full rounded experience of the financial services industry. And so that is the background that I bring to this podcast today. And again, thank you all for inviting me to be here.
Kate, do you want to go next?
Sure, I can jump in. Thank you. So good afternoon, everyone. Welcome. My name is Kate Rock. I am a partner within the financial services segment at Guidehouse. I spend most of my time primarily working with a variety of financial institutions, really helping them stand up and run large programs, as well as providing risk management and regulatory compliance solutions with a focus on fair lending. So certainly looking forward to today's discussion, and thanks everyone for joining us. I'll pass it over to Brian to go next.
Hi, everyone. I also would like to just welcome everyone for joining. We're happy to have you and happy to be talking about this issue. I am senior counsel at Pillsbury in our New York office. I work with many different types of financial institutions on regulatory compliance issues. I've been at Pillsbury for about 18 months now, and prior to that was at the New York State Department of Financial Services, where I oversaw compliance and CRA exams of New York State chartered banks. So I think turn it to you, Greg.
Great. Good afternoon. I'm Greg Heller. I'm a director at Guidehouse. I lead our housing and community solutions practice here. And prior to my time at Guidehouse, I worked in the public sector and also in community development. And I've seen firsthand how important CRA is for shaping programs and investments in communities across the country. And looking forward to being part of this conversation today.
Well, with that, why don't we go ahead and get started with the presentation. I know the first slide's on a little bit of the history of CRA, but I also know, Congressman Clay, that you've got quite a background. So I know you've got some high-level views in terms of the background on CRA. So if you want to give your thoughts on that, that would be great.
Sure. The CRA has been around this is the 45th year. It was enacted in 1977. And it was the idea and creation of the late Maryland Congressman Perrin J. Mitchell, who represented Baltimore. And Mitchell was the first African American ever to represent the state of Maryland. And the CRA was in response to urban decay, the blight, and a lack of investment in communities of color throughout this country. It was also in response to the systemic racism sanctioned by the U.S. government beginning in the 1930s during the Roosevelt administration, when the Federal Housing Administration was created and the decision was made to not extend loans and mortgages to communities of color. And they instituted the infamous red lines, drawing around neighborhoods to exclude them from financial activity. In 1977, Congress found at the time that banks have a continuing and affirmative obligation to help meet the credit needs of their local communities, including low and moderate income neighborhoods where they are chartered, consistent with the safe and sound operations of the institution. So that's a little bit of background, Deb, on the history of the CRA, and it's through the years there have been other iterations of it, but that's how it was started.
That's very helpful in terms of background. Anyone else have any comments in terms of the background on CRA, or do you want to go to the next slide?
I think that leads well into the next slide, so maybe we can go there and start thinking about what this new rulemaking will mean for the CRA and for communities and for the institutions subject to the CRA. There's a lot in the rulemaking, and one of the ways that we have tried to start thinking about what's most important to the regulators that have issued the new proposal is to look at a top 10 list that FDIC Chairman Grunberg ran through last month in some remarks at the NCRC conference when he talked about the rule. And, I think that there are quite a bit of important pieces of information here. I think we'll talk a little bit more about the new assessment areas and how this rulemaking will, it seems at least, make it more difficult for banks to achieve the CRA ratings that they're used to. But I might pause there and see if there are others on the presentation that want to highlight any of these top 10 items specifically, or I'm happy to keep going as well.
Certainly, I find it really interesting that the proposed regs are looking at expanding the scope of illegal and discriminatory conduct to include deposit and other bank activities for the first time. I think that's quite a shift. And I think, obviously even tracking the information is going to be one of the challenges that the covered banks are going to have to be able to do and track appropriately. So there's certainly a significant shift there. I also found it very interesting that it's broad enough, and I think this was actually very much part of the intent, to broaden and clarify some of the ways that a bank can acquire CRA credit, as it were, one way or another. But they're even including strengthening disaster and climate resilience in low to moderate income communities as being one of the things that can now be counted towards it, which I personally think is terrific that it's getting expanded in that way. Anybody else have any other comments that they want to make on this slide?
Well, I think I would just add to that last point. That's an area when I was still a regulator that I know New York and the other prudential banking regulators were thinking about it. So I agree. I think that's a really interesting addition here, and we'll have to see how that plays out and what kind of incentives that really provides for banks to provide financing and loans and investments for these kinds of activities.
Mm-hmm.
Brian, if I may piggyback on what you and Deb have mentioned, it was found that the current CRA regulations do not ensure equitable outcomes for Black households in underserved communities, and that is one of the reasons why policymakers are forcing this change. And it also the change also occurs because of they are pushing for potential broader availability of mortgages and small business lending in underserved areas. And with the thinking behind that, they think it will have a greater impact on low-income, personal, and persistent poverty communities due to the impact that more lending and activity will have on those communities. So I just wanted to add that.
That's great. Okay.
Yeah, absolutely.
Do we go on to the next slide now?
Sure. So, the first thing on the chairman's top 10 list was there are now going to be new assessment areas provided that the rule is adopted in a substantially similar form to how it was proposed. And there are going to be two kinds of assessment areas now under the CRA. And just by way of background, essentially an assessment area for CRA purposes is a physical location in which a bank's performance is evaluated. And so there will remain what are now called facility-based assessment areas. These are the traditional areas in which banks have been evaluated for the most part with some tweaks under the current CRA rules. And that is essentially areas where banks have their branches in other physical locations where they're taking deposits. And the banks will remain evaluated under each of the various performance tests that apply to them in these facility-based assessment areas, which is similar to how the current rule works. The big change is that there will now be what the regulators have called retail lending assessment areas, and this would be a new set of requirements where large banks would have to establish assessment areas where they make at least 100 home mortgage loans or at least 250 small business loans in areas that are outside of their facility-based assessment areas. So this is quite a big change. It's something that I think really lots of folks have been pushing for as the way that folks bank and the way that banks operate has changed significantly. It's been, I think, more than 25 years now since the last CRA rulemaking of any major substance. And of course, folks are much more engaged in digital banking and banks providing digital banking services. So this is intended by the regulators to sort of address that new reality of how banks operate.
Okay. And then, so we'll just take a minute. They have also changed the thresholds for what counts as a small bank, an intermediate bank, and a large bank. Not surprisingly, considering time has changed as well. Small banks now include any entity that has an average quarterly assets computed annually, by the way, of less than 600 million in either of the prior 2 calendar years. And generally speaking, for small banks, with the new proposal, it's really more or less status quo for them unless they choose to opt into the new retail lending test. So I think for small banks, they'll need to, or they may want to give some thought as to whether or not they would like to use the new retail lending test as part of their CRA program. In terms of intermediate banks, obviously, they run from anything above 600 million, of at least 600 million and up to $2 billion. And once again, that's computed annually in terms of average quarterly assets. And it's based upon if there is less than $2 billion in either of the prior 2 calendar years. And for intermediate banks, the retail lending test and the status quo community development test will be triggered with a choice whether or not to opt into the new community development financing test, where once again, for some banks, that may well make a lot of sense to do, and perhaps for other ones, it may not. For large banks now, they've got it split out into two different tranches. The first tranche is a bank with assets in excess of $2 billion, and they would be subject to the retail lending, the retail services and products, the community development financing, as well as the community development services tests. And then for banks over $10 billion, they are also going to have to track and keep additional information. So they're going to be evaluated on their digital and other delivery systems and deposit products, as we mentioned before. They're also going to be evaluated on the deposit product's response to the needs of the low to moderate income or moderate income individuals. So there'll be specific tests and data analytics that will be captured along with that. They're going to have to do a measuring of hours of community development services activity per FTE, which I think certainly is a change, that it's being tracked by FTE in terms of how much each employee is spending on this. Obviously, you may have some that do it full time, but others that perhaps do it far less, but that's certainly a new test. And then they're also going to have to, as we mentioned, keep data on deposits as well as auto loans. And they're going to need a digital system, retail services that's tracking in terms of the deposit products and other community development services. Brian, I don't know if you want to add to these new tests, but those would be the new thresholds, assuming that's adopted as is.
No, I think you've captured it well and really highlighted some of the big and important changes there. And I think it leads well into just talking a little bit about the tests themselves, where there are some changes from the existing rule. I think one of the more interesting changes, and you just mentioned it, is that under the retail lending test, for the first time, auto loans would be included if banks' auto lending meets certain thresholds and certain volume amounts. So that would be a big new component of CRA that has not existed before. There has been an option for banks to have consumer loans more generally included, but specifically including auto lines when they meet this major product line designation, which varies a little bit, but generally, if it's 15% of a bank's business, it can start getting included as a required analysis under the retail lending test. I think another big change here, and this is really throughout, you mentioned it, is just a major shift toward more objective metrics for how banks will be evaluated, and having to meet certain thresholds under the retail lending test. There'll now be a retail lending volume screen, which could, for large banks at least, be it's almost kind of the first test that will be applied and will go a long way toward determining whether a bank actually can achieve a satisfactory CRA rating under the retail lending test. Essentially, it will be an analysis of a bank's retail lending volume as compared to its deposit base in its assessment areas, and tailored to those assessment areas. And if a bank does not exceed the threshold screen amount, there will be a conclusion of that the bank needs to improve rating there, and it will be hard to overcome that. Another big change, and I think we'll talk more about this later too, but want to mention it in the context of the retail lending test, is that small business loans and small farm loans would now be moved out of community development into the retail lending test. And I think that is part of a growing trend where regulators are starting to perceive small business loans as a retail product, and they specifically said that in this rulemaking. There are other rulemakings coming where we're going to see more consumer style requirements applied to small business loans, including in Dodd-Frank Section 1071, which we'll talk about. I think if we can get to it later, and states are also moving in this direction, starting to apply consumer style requirements to small business loans. So this is all a part of really a growing trend in that area. And yeah, I think we can keep moving on to the next slide, which is on just how conclusions and ratings are going to be achieved at. Before I really dive into that, though, I just want to pause and see if other folks wanted to weigh in on the tests.
Brian?
Yep.
Part of the strengthening and modernization of these regulations is, and this is rare in policy making, that all interested parties seem to be satisfied with the fact that these changes will clearly define which activities qualify for CRA credit and give greater clarity and consistency and transparency to the institutions, and clearly delineate the activities that will qualify for the CRA credit. Is that correct?
Yeah, that is correct. And you're right to say that that's something that I think from all perspectives, there has been a hope that will come with this new CRA rulemaking, and we've seen it. The regulators have been moving in fits and starts and trying to get new rulemaking done under the CRA for several years now. And I do think that's a benefit to communities that are going to know what kinds of activities qualify, to the banks that know how to get the credit that they're seeking, and to regulators, frankly, who will be better able to assess and conduct exams without potentially assigning different ratings based on, less objective criteria.
And, so it kind of sets new rules of the road, and,
yes,
and everybody understands.
Yeah, particularly with respect to community development and what qualifies there. There's just a whole lot more detail in the regs themselves than there has been in the past, and I think that's important. Sure.
Thank you.
Yeah, absolutely.
Brian, do you want me to touch on some of the assessment conclusions and ratings a bit, and then you can add your thoughts as well?
Sure.
Basically, the agency is going to have the usual ratings in terms of outstanding. Now they've got high satisfactory, low satisfactory, needs to approve, or substantial noncompliance. But a couple of things that I think are particularly important in this. The agency is going to be able to evaluate the performance of the bank in any state where the bank maintains one or more facility-based assessment areas. And the agency can disregard activities that take place in the portion of the state comprising a multi-state MSA. So that's certainly something that has to be kept in mind. But also a couple other things that I think are extremely important. And that's that if there's evidence of discrimination or other illegal practices at the state or a multi-state MSA or at the institutions levels, the agency's evaluation of the bank's CRA performance can be adversely impacted by that evidence of discrimination or other illegal practices, especially if it includes, not surprisingly, like a COA violation or a Fair Housing Act or Homeowner Equity Protection Act, or Section 5 of the Federal Trade Commission Act in terms of like UDAP type issues. So that's quite a shift. And more than that, they've also decided that the agency is going to look at the root cause or causes of any violations of laws, and if there's been severe consumer harm, and the duration and how long it's gone on, and the degree to which the banks establish an effective compliance management system to self-identify the risks. And then more than that, the agency is also going to look at past performance, so that if a prior rating was, by way of example, and needs to improve, they can decide, even if things really haven't changed, that they're going to drop the rating down a level if they haven't fixed things to be able to improve. And I think that last thing is a particular shift. And Brian, I'd be curious for your thoughts on that.
Yeah, it definitely is a shift. I mean, I can speak from experience that frankly, even a single needs to improve rating has been a relatively rare occurrence. Examiners are very hesitant to even rate a bank less than satisfactory. And so a move to a scenario where one needs to improve, followed by, frankly, performance that would be similar and warrant a needs to improve, could lead to a further downgrade. I think is potentially a very big change to how banks could be rated under these new rules. And I think I would just add to what you said before, to the expansion of potential downgrades for not just discriminatory practices, but really it's pretty open-ended in how the rule or the proposed rule is currently written, where it could be any kind of illegal practice could lead to a downgrade is potentially a big deal as well.
Yeah, Brian, I know we got a question from the audience asking about whether this includes downgrades resulting from non-CRA related compliance issues. I think you just answered that, but maybe you just want to touch on it again.
Yeah, I think it very well could. And I know in speaking to banks, they're concerned about that potential and how open-ended this might be. It's just very broadly written as really any kind of illegal practice. There's the list that you mentioned, but it's an including but not limited to list. So, that could lead anywhere.
Yep. Okay, so maybe on to the next slide.
Sure. So I can jump in here. I think that's been some great background, Brian, Deb, and Congressman Clay, and wanted to kind of transition over to some of the challenges in a little bit more detail. So I think we can all agree that the new proposed rule certainly creates opportunities to address community needs and embrace change, such as that related to digital banking, but brings challenges as well. And some of these we've started to touch on and relate to adapting to the new evaluation methodologies, these enhanced performance expectations, and then I'll touch on a lot of the increased data collection and reporting requirements as well as that are part of the proposed rule. So let's go through each of those. First, adapting to new assessment areas and products. I'll start with the new assessment areas, and I know we touched on this in a little bit, but wanted to just go through some of the challenges we're hearing. And I'll take the retail lending test as an example. And as we've touched on, this, of course, will evaluate how institutions specifically serve low to moderate income borrowers, small businesses, and small farms. In 3 assessment areas: facility-based, retail-based lending, and outside retail lending. So the change and the challenge here is that the institutions will need to identify and separate their retail-based assessment areas from their facility-based ones. So in order to do this, institutions are going to need to really aggregate their lending data for the past 2 years and map it against MSAs or combine non-MSA areas of a state to identify these qualifying areas. Once they have those, they then need to kind of pull out or eliminate areas that are already covered by the facility-based tests and review the remaining ones that have had retail lending volumes above the threshold, as we mentioned earlier, the 100 mortgage loans or 250 small business loans. So really, that's kind of challenge number one, working to identify each of these new assessment areas. Products is the next one I wanted to touch on. And Deb, you've mentioned deposits. We've talked about auto for a little bit. And I think the auto one is the one that stands out in my conversations so far that I've been having. And that, of course, for financial institutions with assets greater than $10 billion, they will need to ensure they're including these types of loans in their analysis. So a significant shift from what we have seen historically. So really working to gain an understanding of what types of products are coming into the scope of the new proposed rule. And then if we look at the next section, developing and executing an implementation plan, Of course, you would need to perform a detailed kind of gap analysis or assessment, but we know that the rule is going to require a significant overhaul of the institution's policies and products, systems, procedures, and controls. And with the proposed 12-month implementation timeframe, institutions are really going to need to make sure they're performing an adequate assessment to identify all of these appropriate changes that are required in a timely manner. So what are some of the things that we would expect to be part of any implementation plan? We've touched on some of them: identifying these assessment areas, identifying the in-scope products, and maybe just to even stay on the path of auto loans. Given that this is coming into scope, what is the additional data you're going to need to be able to have and report on? And do you have it? Or are you going to need to start collecting it? So for auto, this includes identification number, date, amount, location, whether the bank originated or purchased the loan. In the conversations I've been having, I mean, this is not necessarily an incentive to get into the auto lending business. But something organizations are really going to need to think through as they work to get into compliance with the new CRA rule. So not only collecting this new information or data, but of course tracking it, being able to report on it. And in order to do that, you're likely needing to take a look at your applications and specifically your systems. What type of capabilities do your systems have? You're likely going to need to be developing business requirements to make updates to those systems. And given that many systems are managed by third parties, perhaps working with those vendors to process any required changes that allow for that, again, collection, tracking, reporting of these additional data points, particularly around some of these new products like deposits, auto lending, and the additional community development activities. And maybe the last thing I'll touch on in this implementation plan section is just the new statistical regression tests, the additional formulas, metrics, and ratios. So you're going to, of course, need to get an understanding of them. But again, do you have the data that you're going to need in order to perform these tests, these metrics, these calculations, and then actually building out, of course, these metrics. And then ensuring that you have individuals who are reviewing and analyzing the results really on a recurring basis and comparing it against perhaps your peer institutions, because you know that's what's going to be happening, and determining, do I need to make any tweaks to my own program kind of as we proceed. And then the last item here on this slide, I think I've touched on this quite a bit, around the collecting, tracking, reporting of the additional data points, particularly around the quantitative piece, but maybe on the qualitative. And we've touched on the expectations that there's going to be of organizations, institutions getting out into the communities, having those conversations, ensuring that they're getting an understanding of what products and services are needed within low to moderate income or underserved areas, and working to ensure that they are tailoring their products and services accordingly. So just some additional information that organizations are going to want to make sure that they are keeping track of. So if we go to the next slide, I guess based on all of that, you might be wondering, where do we even start? Of course, you're going to want to take a look at the proposed rule. It is quite lengthy, but you certainly need to get an understanding of the rule as it is written, even though there might be changes as the comments continue to come in. But where can you start after that? You'll want to make sure you establish working groups. So pulling together the right stakeholders across the organization, coming from all of the applicable different departments or functions within your institution. Identifying those that are going to be responsible for driving progress, those that are going to need to be responsible for making any kind of key decisions on how the institution will move forward as they work to get into compliance with this new proposed rule. Identifying the scope, touched on this, of course, the new business areas, the new products that are coming into scope, and really understanding how this is going to impact your organization based on where you do business and the products you offer. Evaluating technology, I've touched on this, but certainly need to evaluate the current state capabilities of your systems and start to identify the updates that are going to be required to your systems in order to be able to collect that information as we've talked about. And then performing gap analysis, I've touched on this one as well, but of course, taking a look at your covered areas, applications, data collection practices, and really building out and identifying where are the gaps within my organization compared to these new CRA requirements. What are the key steps we're going to need to take in order to get into compliance? And then that information is really going to help inform that implementation plan where you can start having your detailed steps, laying out the time it's going to take to complete, and also identifying any kind of dependencies or downstream impacts so you know what needs to be occurring when over the implementation timeline that you have. And before we go to the next slide, I think one thing that's interesting just to point out, and I was actually able to attend a banking conference a couple of weeks ago, and one thing that stood out was comments around the fact that past performance as it relates to your performance on CRA, so a little bit different than what we were talking about before, is not going to be a factor in organizations. We've talked about these enhanced performance expectations. They're really going to need to do more to get those outstanding or high satisfactory ratings. And the comment during the conference was on a study, and it was a member from a banking association and a member from a bank speaking. But they talked about a past study that took existing kind of CRA data and applied it to these new CRA requirements. And the results were that 22% of banks today would be high satisfactory and 6 would be outstanding. So as you can see with those results, just a little over a quarter of organizations would fall into those top 2 buckets. So really just kind of putting some numbers and demonstrating the higher expectations that are coming out of this new proposed rule.
I think that's actually, just pausing really quickly, I think that's a great point. I know that regulators currently are really, really hesitant to downgrade a bank, and they're able to probably find ways to keep a rating the same, whether it be satisfactory or outstanding, with the discretion that's currently written into the rules. But as the metrics take hold, there's not going to be that ability to try to fit yourself into that existing rating you have. So that's a really great point, I think.
Yeah, no, thanks. Yeah, quite interesting when I heard it the other day. And so here on this slide that we have up is perhaps the last kind of challenge just to highlight for the group today. And this is the fact that the implementation around CRA is likely going to be happening at the same time as the implementation of 1071. And Brian, you brought 1071 up earlier, but for those who are not familiar with it, Section 1071 of Dodd-Frank did amend COA to require institutions to collect and submit specific information related to credit applications from women-owned, minority-owned, and small businesses. So again, another one with significant data collection and reporting requirements. We recently have heard that the Bureau has agreed to finalize the 1071 rule in the first quarter of next year. So by March of next year, we expect to see the final version of 1071. And if the 18-month implementation timeframe holds true, we've kind of laid out what that might look like here on the slide. And then as it relates to CRA, even if this rule is not finalized until the middle of next year, if the 12-month proposed implementation timeline here holds true, you see that there's going to be significant overlap with both of them potentially needing to be implemented by the middle of 2024. So again, just adds additional complications as you're building out those implementation plans. Really pay attention to kind of some of those dependencies and downstream impacts. And even if your systems, what do you have in flight already that you're updating? And then what order do you need to be updating for CRA 1071 or any other activities that you have ongoing at that time? So certainly could talk about that more. And if we do have time at the end, we'll spend a little bit more time on 1071 specifically. But with that, I'm going to stop and pass it over to Greg, who's going to dive into really CRA and impacts to the community. So Greg.
Great. Thanks so much, Kate. So to start, I just want to kind of level set the importance of CRA. It's an incredibly important tool for public entities, community developers, nonprofits who rely on CRA-motivated capital for a number of programs and projects. And it's truly essential for ensuring access to capital for underserved communities. So I think it's really incumbent on the regulators, banks, and community partners together to make sure that that both the rule and the way it's applied are getting it right for communities. And in my years of work, I've worked with a number of financial services partners who truly care about serving people in communities and about doing the right thing and making sure that those communities get access to capital. So I think these are really the key questions that the proposed rule is trying to deal with are, what is a catalytic investment and what's the true power of CRA for communities? And the joint notice even says in the introduction that even with the implementation of the CRA and other complementary laws, the wealth gap and disparities and other financial outcomes remain persistent. And then another quote from the joint notice is, in considering how the CRA's history and purpose relate to the nation's current challenges, what modifications and approaches would strengthen CRA regulatory implementation in addressing ongoing systemic inequity in credit access for minority individuals and communities? So the point is clear that the changes to the proposed rule are largely focused on trying to overcome the challenges that the rule was made to address in the first place. Let's go to the next slide, please. And there have been a number of third-party studies that have looked at the impact of CRA on communities and found that there have been measurable impacts, but a number of these research reports also show that CRA has not gone far enough to promote the goals it was established for. And just quoting one of these studies on here from Urban Institute, quote, although the CRA has expanded credit access to underserved communities and borrowers, current regulations do not ensure equitable outcomes, particularly for Black households and underserved communities. So this is all really the context that the changes are targeted at, is increasing the impact of CRA on the ground for people and communities. Let's go to the next slide, please. And then also, before I get into some of the actual elements of the proposed rule, just reminding everyone of the ways that CRA can be effective in impacting communities. So some of the keys here are that when banks make investments, that they do it in a way that's data informed, that there's collection and evaluation of data, that investments are coordinated and clustered, focusing on access and availability for underserved populations, that they're part of a long-term strategy. And this is something that the proposed rule emphasized, is coordination with state and local strategies and approaches, that they're focused on resilience. And again, we mentioned before this new focus on climate and disaster, that they're partnered with local government and community stakeholders, that they evaluate and measure social impacts. And I think increasingly it's clear that financial services companies are going to have to get more sophisticated and have more data points for collecting that data, measuring those impacts, and reporting on them. And that they're informed by qualitative feedback by community stakeholders. So not just the quantitative data, but also looking at a mixed methods approach that uses qualitative input as well. Next slide, please. So these are some of the major proposed changes I think that are worth discussing here. And as mentioned, this is going to add rigor, and there's certainly a much more complex set of tests. But I also think there are a lot of elements here that add focus and transparency and clarity. So, I mean, one of the elements is that this proposed rule to allow banks to receive CRA credit for any qualified community development activity, regardless of location, which is very significant. The new 4-part test obviously is going to be much more rigorous, especially the community development financing test and community development services test. So, as you can read in the proposed rule, the community development financing test would consist of community development financing metric, benchmarks, and impact review, which would be assessed at the facility-based assessment area, state, multi-state MSA, and institution levels, and would inform conclusions at each of those levels, and that it would consist of a primarily qualitative assessment of the bank's community development service activities. So again, emphasizing the importance of collecting data and figuring out ways to quantify and evaluate those community impacts. We talked about the new data reporting requirements for large banks. The other thing I want to mention, separate but related, is that the agencies are proposing providing additional information to the public in the CRA performance evaluations for large banks relating to the distribution by borrower race and ethnicity that they're getting from existing HMDA data. Another one is the new primary purpose standard for the community development financing and community development services. So under this proposal, a loan or investment or service would meet the primary purpose standard when it's designed for the express purpose of community development as set forth in the final rule. So in general, activities with a primary purpose of community development would receive full CRA credit for the financing test and community development services test. So hopefully there's some questions here that'll be answered in the final rule to clarify that primary purpose standard. This, the fact that there's going to be pro rata credit available for affordable housing, and potentially they leave this as an open door, but potentially other community development activities. So that would be an interesting new element that would allow for CRA credit for part of those activities. The proposed definitions and standards for affordable housing is a section that I would encourage everyone to read closely. And I think that's really necessary for getting more granular in terms of defining what counts as affordable housing. And the proposed rule also has this new section on naturally occurring affordable housing, so unsubsidized affordable housing. And it has several potential tests for determining whether that type of housing product qualifies for CRA credit. It does leave a number of open questions that hopefully will be answered after the public comment period, including whether to qualify naturally occurring single-family housing in addition to multifamily. But under the current framework, there's not a specified standard for determining when a property or unit is considered affordable to LMI individuals. So this is a pretty significant new section. And there's also the inclusion of some innovative activities and shared equity models, which I thought was interesting. So this is under Part 4, activities that support affordable home ownership for lower moderate income individuals. And this talks about things like community land trusts and shared equity models that, I think are fairly innovative, but it opens the door for banks to proactively get CRA credit for those types of activities. And then, of course, as we said before, the defining disaster preparedness and climate resilience activities, which increasingly are very much connected to affordable housing and underserved communities, as we've seen in recent years. The new impact review factors are also very important. So there are these impact reviews for community development activities as part of the community development financing test and the community development services test. And these are factors like persistent poverty, low levels of community development financing, activities serving low-income individuals, affordable housing in high opportunity areas. So these really define by the agencies some concrete areas that they want to see banks focus on with those activities. Something else that I think is really important for providing transparency and structure for banks is this proposed illustrative list of qualifying activities and a method to confirm eligibility of activities. So they've left the door open for a lot of new types of activities, and that illustrative list, I think, will help understand in advance whether specific investments are going to be CRA eligible or not. And it's going to be a non-exhaustive list. In addition, they're also going to propose including a process for modifying the illustrative list for activities periodically. So it seems like there's an open door for some back and forth and feedback with banks who are looking to see whether certain activities are going to be eligible. Then there are alternative approaches to create a more targeted definition of qualifying mortgage-backed securities. The proposed rules talked about this issue of banks purchasing a large quantity of MBS and then selling them after their examination, and so I think it's trying to head off those types of issues. We talked about the loans to small businesses and small farms being evaluated in the retail lending test instead of the economic development definition. And then finally, further defining community supportive services and providing a list of standards that banks can use. So again, like the illustrative list before, this is focused on giving more structure and examples so that banks can have more certainty up front of whether certain activities will qualify. For example, it says in the proposed rule, the agencies are proposing that workforce development and job training programs, which are currently qualified as a component of economic development, would instead be considered under the proposed definition of community supportive services. So let's go to the next slide, please. So just some potential impacts that the changes in the proposed rule could have. Obviously, broader availability of mortgage and small business lending in underserved areas. This potential focus on climate resilience and disaster preparedness, a space that we're certainly going to see expand in the coming years. Potentially, there's broader availability of low-income housing tax credits, new markets tax credit investment in more parts of the country. There's this potential focus on different types of affordable and mixed-use housing and shared equity models, and this potential greater impact on low-income persons and persistent poverty communities due to the impact factors specifically calling out those areas. And then last slide here. So just some additional things to consider. There's been a lot of discussion for years about the CRA's creation focused on combating the impacts of redlining and the potential of actually including race within CRA. Obviously, the proposed rule talks about race, but does not include race as an impact review factor. And then there's questions around how to ensure that CRA investments are part of a coordinated and impactful community rebuilding strategy. So there is this focus on collaboration with local and state partners and plans, but I think there's still a lot of open area for how that coordination can and should take place. Questions about ensuring that LMI households are being served with affordable housing units and defining affordability, and a lot of those questions are discussed and left open in the proposed rule, which hopefully will be defined in the final rule. The potential for banks to meet the financing portion of the community development test through lending alone or primarily through lending. The fact that community banks are still only subject to the retail test, so small, medium-sized banks, and that banks who are satisfied with with a satisfactory rating don't necessarily have incentive to focus on the impact review factors. So these are just some things that are being discussed within some of the conversations I've been part of, and there are a lot of questions still left open that hopefully will be answered after the public comment period is over and the proposed rule comes out. But also, I think a lot of new information in here, a lot of new challenges for financial institutions to collect the data and create the methodologies they need to evaluate this, but I think also some really good concrete strategies for clarifying what's eligible for CRA, and some evidence that the agencies are trying to be more transparent and upfront about how banks can best succeed under this new proposed rule. All right, I'll leave it
and
there.
if I recall, the time frame for submitting comments is August 5th. Is that right, Brian? That's my recollection. Okay.
That's correct. Yep.
And so for the last couple minutes, when we go to the next slide, for the last couple minutes, we're going to spend some time talking about some of the fair lending and the Dodd-Frank 1071. But before we get into that, I just thought, Congressman Clay, I know you've been very involved in terms of fair lending issues for a very long time now. So I thought you might want to give some of your views in terms of, Congress's thought on some of this, or just some of your background before we have Brian and Kate talk through the last slide.
Sure, Deb. And the 2 points that I want to make dovetail into what Greg was talking about. One is the rate of home ownership, which is the primary driver of wealth for most families in the U.S. During the pandemic, a housing boom, millions of Americans took advantage of historically low interest rates to refinance or purchase homes, while millions of others, like millennials, Gen Zs, and people of color, were unable to access financing. And the wide gap between racial wealth and home ownership continues to widen. These groups are being locked out of home ownership and wealth gains. And one of the solutions that you will see Congress directed towards will be down payment assistance for first-time home buyers. And real quickly, the other issue that I want to raise is the inequality in home valuations, including appraisals. You will hear much more from Congress about how to root out bias and discrimination in the appraisal industry. Systemic undervaluation of homes owned by people of color and located in communities of color has blocked many Black homeowners from fully benefiting from the equity in their homes, from refinancing their mortgages and really selling their homes. And biased valuations that affect mortgage loan to value requirements can also block individuals from becoming homeowners altogether. So one of the solutions you will see an intense focus on will be coming up with a pool of more diverse appraisers and more anti-bias training in that industry. So, Deb, those are the 2 points I wanted to raise, which I think the revisions in the CRA may get at too.
Thank you so much. That was super helpful background. And then Brian and Kate, do you want to talk a little bit more about Dodd-Frank Section 1071?
Sure, absolutely. And yeah, great comments. And just to go into 1071 in a little bit more detail in our last few minutes here, this is something we could spend another hour talking about. So we'll try to do it justice in these couple of minutes. But to make sure everyone is aware, in September of last year, the CFPB did issue an even longer 918-page notice of proposed rulemaking under Dodd-Frank. And again, this proposed rule specifies certain data points that institutions will be required to collect and report on related to small minority and women-owned businesses. The stated goal of 1071 is to increase transparency in small business lending and facilitate enforcement of fair lending laws and identify ways to ensure equal credit opportunities for those small minority and women-owned businesses. Some of you may have heard of 1071 being referred to as the HMDA for small business lending, but certainly want to point out that it has perhaps some more comprehensive implementation and compliance concerns due to the scope impacting a greater population of institutions and a greater variety of products and services. So I've mentioned data collection efforts. So what type of data is going to be required? The proposed rule does list more than 20, so 23 to be exact, mandatory fields. Some of these institutions are already capturing as part of their credit applications, but there are some newer fields such as race, ethnicity, and the sex of the applicant's principal owners. There's also a group of data points that at one point were optional, but as the proposed rule has been drafted, have shifted over to mandatory. And these include things such as application method, application recipient, pricing, NAICS code, the number of principal owners, the number of workers, and time in business, among others. So where should you start? What should you be thinking about? What are the challenges? I don't think we have all the time to dive into that, but similar to what I've already spoken about as it relates to CRA, but of course, looking at your policies, procedures, training, ensuring you're coordinating across the organization, and pulling in all of the right parties. I've heard that the data, particularly for 1071, depending on how you set up your business, you could have data coming from multiple systems based on how you do your lending. So needing to make sure that you're talking, you can compile that information as it is coming out. Do you need to update those applications? Do you need to update those systems as we've talked about earlier? Third-party oversight and ensuring you have the proper data quality and data reporting controls. So again, just some things to quickly think about here today. But I'm going to pause, Brian. I know this is a topic similar to CRA that we've spent a lot of time talking about over the past several months. So what would you like to share with the audience today on 1071?
Yeah, I guess just two quick points as we wrap up here. One is that I think it was good news in many ways to get some certainty about when this rule is actually going to come out. There's been a lot of work to get to this point, but one of the questions that came up early on after the CRA rule was proposed was how is 1071 going to play into these new potential requirements for small business loans under the CRA proposal. And there was in that proposal, because it was put out at a time in which there was still uncertainty about when 1071 was going to be final, about potential transition periods for what was going to count as a small business or small farm loan, or how that was going to work as we got to a final rule here. So as you mentioned before, hopefully getting to a point where these two different rules that are quite related start aligning will make it operationally and from a compliance perspective a little bit easier to manage, although obviously there's going to be a lot of work to do on both fronts. And then just the second point, and this is more of a niche point, but one of the things that I worked on when I was still a regulator in New York is that New York has its own CRA, which in many ways is similar to the federal CRA, and I do expect New York and the handful of other states to try to line up as much as possible with the new federal rule. But New York has some additional requirements, including a new requirement to do an analysis of lending and other activities involving minority and women-owned businesses, but has been struggling to implement that requirement and really give any clarity to institutions on how the regulator in New York is going to try to implement that without the data that Section 1071 rulemaking will now provide. So, from the perspective of banks and at least the New York regulator, there'll be a little bit more of a clear expectation with respect to the data that is going to go into that newly required analysis.
Okay. Well, I guess that's about it for today. For those of you who are listening for the CLA education credits, The number is 2022-047. So hopefully that's helpful for some. And then if anybody has any last comments they'd like to make on our very wonderful other panelists, certainly anybody can make any closing remarks. Okay. Well, I guess with that, thank you so much for everyone who's listening, and for those who participated, and certainly for the panelists. And hopefully this is all of some value. It is a long proposed reg. I will say that. So if you get to wade your way through it, just prepare yourself for a couple hundred pages of Federal Register print. But at any rate, with that, thank you so very much to everyone. And as always, we appreciate your participation and listening to us. Thank you.
Thanks, everyone.
Thank you. Take care.